Welcome back to Real Estate 101. Today we're going to continue our discussion on real estate and investment properties and tax issues, and I'm pleased to be joined by Sabina Mexis of Devry Smith Frank. Sabina, welcome to the show.
Thank you very much. Thank you for having me.
So, Sabina, my first question is, what does, I guess, the government consider an investment property for tax purposes?
Okay, so an investment property is distinguished from your principal residence, and that would be the property in which you do not reside.
Okay.
So, for example, if you had your house that you live in, and then you have a second property that you either rent out, or you may also have it and your children live in it, or your parents live in it, for example, that property wouldn't be considered your principal residence. It would be an investment property or not your principal residence for tax purposes. So anything other than where you reside.
Okay, so how is the tax treatment, how does it differ from your personal property and an investment property? Okay,
so most people are aware that when you sell your principal residence, you don't pay any tax on the gain.
It's exempt.
It is exempt, that's right. So what you're supposed to do on your tax return when you sell your principal residence is file what's called a principal residence exemption, and that will exempt the amount of gain on the sale of your principal residence from tax. In an investment property, there's two possible tax consequences that can result. One is if you have just one investment property and you sell that property, the gain on that property can be treated as a capital gain.
Right.
So a capital gain is a gain where only 50% of the gain is taxable. If you have an inventory of properties, and there really isn't a hard and fast rule as to what constitutes an inventory, but generally when you are getting to the point that you have 4, 5, 6 properties, you've gone from having capital gains treatment to regular business income treatment. So what that means to a taxpayer is that the gain on the sale of an investment property that's considered income is not subject to capital gains treatment. The 100% of the gain will be taxable as regular income.
Now, I know in a previous episode with Aldad, who's also from your firm, he had mentioned that sometimes even flipping just one property may be considered you're running a business.
Yes. So it depends. The CRAs vary, especially in this market. They're clamping down very hard on real estate flipping. I've had a number of clients who've been audited for what the CRA considers excessive sales. Happily, in the situations that I had, my clients had, they were in fact legitimate home. They resided in the home, so they weren't flipping. But often I've had situations, or I've had people call me and say, well, I put this one in my mother's name and I put this one in my brother's name, and so I think we're all covered. You know, you're really taking a gamble,
right?
Because if the CRA is going to choose to audit you, they're going to then expand the scope of how far they're going to look as far as determining whether you're carrying on a business or not. And sometimes that can be the flow of funds. If the money seems to be coming from one source, but it's being flowed out to properties that are in a number of different names, then you're potentially setting yourself up for audit because it is really running a business. And the fact that you've put somebody else's name on title doesn't really negate the fact that you are in fact running a business.
If it looks like a duck and quacks like a duck. Right.
That's right.
Okay, so is there like a parameter that can be used? Like some people say if you live in the home for a minimum of 6 months, then it is considered a principal residence. Is that one of the things they use?
So no, not really. There isn't a hard and fast rule as far as length of time, because someone could have lived in the house for 6 months but still be engaged in the business of flipping homes. So in order to be able to claim the principal residence exemption, the home has to be ordinarily occupied by you. So we see this often in the context of new homes where people are claiming the GST rebate. And what they'll do is they'll buy the home, and as you know, it takes many, many months, sometimes even years before the house is ready. They'll intend to move in, and either they will not move in or they'll pretend to move in. So they'll put furniture in there and they won't move in, but still claim the rebate. So the CRA is very aggressively auditing people who don't occupy the home. In fact, there are cases that have been reported where the CRA has gone so far as to send investigators to knock on the door to see if people are answering the door, if they're actually residing at the premises. They'll ask the concierge, if it's a concierge condo building, if there's someone actually coming in and out. They'll look for a mail. So they really are very aggressive as far as trying to find people who are saying that they're living in a home, but in fact are either carrying on a business or they're flipping the properties.
So is there any way to claim the principal residence exemption on an investment property?
Only if you live in it. I mean, really, if you have an investment property, the principal residence exemption is only one per, it used to be one per taxpayer. That's not the case anymore. So husband and wife, for example, do not each have a principal residence exemption.
So it would be household.
Right. It's really one per household. So let's say you have a property and your children reside in it, and you have your own property that you reside in with your wife. If the house that your children reside in has a greater accrued gain, and therefore there would be tax payable on that gain, if you sell the house that your children reside in, you can claim the principal residence exemption on that property. So if you have a property that, let's say, is a duplex or something, your kids live in one half and you rent out the other half of the property, you can claim the principal residence exemption on the property that your children are residing in and only the half that your children live in. So there's a lot of intricacies to claiming the exemption. It's not simply picking which property you want to claim. It all depends on the use of the property as well.
All right. So let's touch a little bit on the types of ways to acquire real estate. You can obviously do it personally.
Right.
What are some other ways? So
personal ownership of real estate is the easiest, and many people will acquire it primarily for financing. I have, in my practice, I find that when people who are real estate investors own a bunch of real estate properties and they've acquired them in their own name, and usually they get up to about 6 or so that they hold in their own name, then they are looking for alternate ways to hold that real estate. Now, there's a few things that I want to discuss with you with respect to the alternate ways and ways to transfer property, because we do have land transfer tax, and in Toronto, of course, we have Toronto land transfer tax on top of Ontario land transfer tax. Exactly. Right. So people who are holding their property personally, they do so because it's easy. It's relatively easy to acquire financing. You have to put less down, and usually you'll get a better rate than if you're holding corporately or through a partnership. So those are some other ways you can acquire property corporately. So you can incorporate a corporation. It can be the one that acquires the real estate. And you can hold real estate in a partnership. You can also hold real estate in a trust. So these are the various options. If you buy real estate personally and then you transfer it, in most cases there will be land transfer tax, and particularly if you transfer to a corporation.
Even if you own the corporation.
Correct. Yeah. And that is something that a lot of people don't realize. That if you hold real estate personally and then you try to transfer it to a corporation, you will pay land transfer tax on the fair market value of the transfer.
Wow.
Yeah, so that's a big land transfer tax bite there.
Okay, so what are the, advantages of owning it personally?
So the advantages are really the ease of, you can just go out and acquire property. And in most cases, it's the ability to acquire financing with having to put less down and getting a better rate. That's really the primary advantages. It's easy in terms of the acquiring the property and financing the property.
Now, are there any disadvantages to owning it in your personal name?
The disadvantages are, if you become a landlord and you have multiple investment properties and you've got tenants, you're potentially putting your personal, or not potentially, you are putting all your personal assets at risk with respect to any liability for unremitted taxes, with respect to any injuries or anything that might occur with respect to your rental properties. So you bear all of the liability and the risk in connection with personal ownership, and that is your personal assets. It's not limited just to the property in which the accident, say, occurred. If someone sues you, so let's say there's a trip and fall in one building and you own 6 buildings, all of your assets are potentially at risk with respect to satisfying a judgment if there is one against you.
Right, because they're not owned by a separate entity.
No.
Okay. So is there, I guess this would be different for everybody. There's not one thing that works for everybody. It depends on the situation. Like, it's not just to go out and acquire real estate under a holding company.
Right.
I guess in each case it's different.
I think in many circumstances, for example, if you have people who own residential real estate, which is very commonly what I deal with. Residential real estate is going to generate rental income, of course, and that rental income, if it's owned personally, from a tax perspective, there's no deferral. And what I mean by that is when the income is earned, you must report it on your tax return, and you must pay income on that income. Sorry, you must pay tax on that income in the year that it is earned. So there's no deferral for tax purposes, and you pay tax on whatever your marginal tax rate is.
Right.
Now, of course, you are able to deduct your expenses against the rental income. So expenses for property management, expenses for landscaping and property tax and so on. Those are all deductible expenses to reduce your net income. But whatever that net income number is, if the properties are owned personally and they're owned by one person, then that one person is responsible to pay the tax on all of that income. There's no income splitting possibilities. There's no ability to sprinkle income amongst lower income family members. If you're the sole owner, you pay the tax on the income. Now, if you own it through a corporation, the corporation is the taxpayer. It's the same principles that apply as far as deductions. You are able to get deductions for the regular expenses against your rental income.
Right.
But the net income is taxable in the corporation.
In the corporation,
yes.
and it could be deferred.
Well, it can be deferred at the personal level. So the corporation does pay the tax in the year that the income is earned. But then if the individual wants to withdraw the net income by way of dividends, then that can be deferred. So that's the deferral opportunity at the individual level, not at the corporate level.
Right. So when you're meeting with clients, it's a case-by-case basis.
Right.
You kind of, you belong here, you belong
right.
here.
The other big thing that people need to be aware of if they're going to hold property through a corporation is the tax rate. There's a huge misconception that if you own your real estate through a corporation, an Ontario corporation, you're entitled to the small business rate, which is 15%, 15.5% in Ontario. That's not correct. Under the Income Tax Act, real estate rental income is considered passive income, and it's taxed at the investment income rate, so almost 50%. So there is no tax break unless you have 5 or more full-time employees, so you have a variety of properties and you've got enough that you need 5 or more full-time employees to help you manage them. Then you can get access to the small business rate. This is a very common mistake that I see all the time.
All right, Sabina, great stuff. So for people watching and listening who may want to get in touch with you, how can they reach you?
So you can call me. My telephone number is 416-446-3348 or email me at sabina.mexis@devrylaw.ca.
All right, Sabina, great stuff. Thanks for coming in. Hope to see you again sometime down the road.
Thank you very much.
All right, so there you have it. If you're looking for a top real estate tax lawyer, get in contact with Sabina Mexis of Devry Smith Frank. Don't forget to subscribe to our YouTube channel, like, comment, and share our videos. I'm Joe. Thanks for watching, and we'll see you next time.